Hello, in this lecture we're going to record a transaction related to the accounts payable cycle in which cash had paid for supplies that were purchased in the past. So here's our owner putting the cash into the mail to be sent to the vendor. Probably would be a check in real life, but the point is that we're paying today for something that happened in the past in this case. We're going to record this journal entry over here on the left hand side and then post it to the trial balance on the right hand side where we have assets in green, liabilities in orange, and the equity section light blue, the income statement part of the equity section in the darker blue, including revenue and expenses. First question, is cash affected? In this case, it is. We paid cash, says paid cash. Therefore, we can see that cash is an asset. Assets have debit balances represented by the fact that there's no brackets around it on the trial balance, and we need it to go down because we decreased cash. Therefore, we're going to do the opposite thing to it as what it is. It's a debit. We're going to credit it, doing it in the opposite. We're going to put the credit on the bottom as credits typically are. We are then going to post that out. So we had 50,000 and then we have a credit of 450, causing the balance to go down from 50,000 to 49,550. If we credit cash, what then will be the debit? And you might be saying, well, it should be supplies because we purchased supplies. But remember that we purchased supplies in the past and now we're just paying for the supplies. So we're basically paying off the IOU that we owe someone else, a vendor, that account being the accounts payable account. So the accounts payable account we can see is a credit balance account. We're going to make it go down because we're going to pay it off and therefore it needs to decrease. And therefore we are going to do the opposite and debit that account. So again, we knew we were going to debit it because we credited cash. And therefore we had to debit the other account in this case being accounts payable. But we can also work that out and see that accounts payable has a credit balance. We need to make it go down by doing the opposite thing, which is a debit in this case, bringing that balance down to 0. The effect on the accounting equation is that the assets went down because cash went down, and the liabilities also went down because the accounts payable liability went down, and there is no effect on the entire blue section being the equity section. On the income statement, nothing happened to net income, meaning nothing happened in the revenue and expense areas, net income being part of the owner's equity.